Hi, I'm Josh Brown, CEO of Ritholtz Wealth Management. Welcome to FAQ. On this show, we try to answer the questions that we get from investors and other financial advisors just like you about some of the most important topics for everyone. On today's show, we're going to address how anyone can build a recession-proof portfolio. Let's get into it.
Without money, he has nothing to manage.
How often do recessions occur?
Since the end of World War II, we've had 11 official recessions, so about every 7 years on average. But of course, it doesn't work that way. For instance, the last recession ended officially in June 2009, so it's been over a decade since we had the last one.
I have news for you. It is not the investor's job to try to anticipate recessions and dance in and out of them. This is something that literally cannot be done even by professionals. The most well-armed, well-informed, most experienced people in this industry can't do it. So why would anyone else even try?
The average recession since 1945 has lasted roughly 11 months with an average GDP decline of around 2.4%. So not terrible. So if we look at the last 75 years, that means roughly 130 months have seen the country be in a recession in the United States. Now, there's two ways to look at this. One way, that means 15% of the time we're in a recession, we're in an economic downturn. But if you're more of a glasses half full kind of person, that means 85% of the time the economy is expanding and we're not in a recession, things are going okay.
And where do these recessions even come from? Who says, okay, recession begins, recession ends? It's a group called the National Bureau of Economic Research, which is a nonprofit research organization. So here's how the NBER defines a recession. The NBER does not define a recession in terms of 2 consecutive quarters of decline in real GDP. Rather, a recession is a significant decline in economic activity spread across the economy lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and whole retail sales.
Peter Lynch, one of the greatest investors in history, ran the Fidelity Magellan Fund, outperformed the market to a degree that almost no one else has been able to do in mutual fund management, made a comment that more money has been lost anticipating recessions than actually living through them. And I think that's absolutely true from what I've seen. In my view, the investor's job is to build and maintain a portfolio that's durable for anything that the market and the economy are going to throw at it.
Why is it so hard to predict the market's reaction to a recession? The simple answer is because you never know where the recession is going to come from. In 2007, it was housing and way too much credit. In 2000, it was actually the stock market that caused a recession. But you never know where it's going to come from. You never know how long it's going to last. You never know how long when it's going to end.
So there's an old saying that the stock market has predicted 9 of the last 5 recessions. I think that's attributed to Paul Samuelson, who was an economist back in the day. And the idea here is that the stock market is not the economy, so stocks will fall double digits at times, or even have a bear market outside of an economic contraction, which is true. And it's also true that the stock market is not exactly Nostradamus when predicting these things and what's going to happen in an economic downturn. So if we look out 3 to 6 months before the last 11 recessions since World War II, 3 months out, the average return on the stock market in the S&P 500 was 1%. 6 months out, the average return on the S&P 500 was 1.2%. So in both instances, it's not like the stock market was screaming red, everyone get out, there's panic in the air, because the stock market doesn't line up perfectly with the economy all the time.
Can you implement a strategy based on whether the NBER says we are or aren't in a recession? Well, the problem is nobody knows in real time. So the recession ended most recently in June 2009. They didn't tell you that until September 2010, at which point we were already 65% off the lows. Now, let's just say that you did implement a strategy based only on what the NBER says. If you did that since 1980, your returns would have been cut in half. In other words, if you went to cash when they said that we were in a recession, and then you got invested when they said the coast is clear, your total returns would have been half had you just bought and hold, which brings up a very important point. Should investors try and time the market or avoid recession? The answer is no. It is much more reasonable and feasible that you can survive an economic drawdown and a drawdown in your portfolio versus avoiding it. In other words, timing these things is incredibly difficult because not only do you have to get out, even harder, you have to get back in.
Not all recessions are created equal. They can vary in terms of how shallow or deep they are. They can vary greatly in length. They can be just a few months. They can be a few years. So even if you knew one was coming, that wouldn't tell you about how bad it'll get. And it certainly wouldn't tell you exactly what asset prices like stocks and bonds are going to do at any given point during the recession or when they'll start to anticipate the end of it.
What other variables beyond economic growth enter the picture? Well, everything is tied to the economy in one way or another, whether it's manufacturing or things like inflation and interest rates. But two things that are maybe a little bit outside of the economy that enter the equation, one can be quantified, one can't. One are valuations, not necessarily tied to the economy. The other thing that is really hard to quantify, probably impossible, is how do investors feel? What's your overall mood? And what are they going to do to stocks when the economy turns? Unpredictable.
If we only went by GDP growth, that would be one thing. But think about how many other things impact the market. Starting valuation, for example. How much are people paying for earnings and how much room is there to the downside for that to fall? What about demography? What about economic trends around the world? International situation? What about those sort of waves of innovation that come along and completely change the course of the economy, for good or for ill? There are way too many variables for us to just focus on GDP growth and say that that's going to give us all of the answers we need as far as how the stock market will fare during either an economic expansion or contraction.
So I looked at the unemployment rate going back to 1945 again during a recession. It typically bottoms out at an average of around 4% during an expansion. So right now it's at 3.7. The lowest on record is actually 2.5%, which was reached in the 1950s, which kind of seems crazy now, but anything is possible, I suppose. And during a recession, the average peak of the unemployment rate is roughly 8%. So let's say on average, we see an average increase of around 4% in the unemployment rate. So the current labor force in the U.S. is estimated at 160 million people. So if we were to see a 4% uptick in the unemployment rate during the next recession, that means roughly 6.4 million people are out of work. So that's a huge, huge increase in people that are looking for a job. And so even a mild recession, like something we saw in, say, the early 2000s, which was just more of a blip on the radar screen in terms of GDP, if you lose your job or you have a business that goes under, that feels more like a depression to you than a mild recession. So the economy is always personal in these ways in terms of what happens to individuals and households. So it's important to remember that if your biggest concern is, I wish I would have had a 50-50 portfolio instead of a 70-30, and that's your biggest concern is your portfolio performance going into or out of a recession, on a relative basis, you're probably doing okay.
How does diversification across different asset classes help investors get through a recession? I think it's really important to consider the fact that not all asset classes move together, and many asset classes that you would include in a typical portfolio can deviate in any given month, year, 2-year period of time.
Stock market crashes may not line up perfectly with the economic calamities that happen in the downturns, but pretty much every recession since 1945 has seen a pretty sizable correction in the stock market. And the only time it didn't happen is actually 1945. There was a brief 3 or 4 month recession following the end of World War II. Stocks only fell around 6% during that time. Every other recession since then, so the past 10 recessions, we've seen at least a double-digit correction in the S&P 500. And so the average decline has been 29%. And so 8 of the past 11 recessions have seen at least a 20% pullback or worse. 4 times it's gone down 30% or more during a recession. And the 8 bear markets that corresponded with a recession over the past 75 years in the S&P 500 saw stocks fall an average of 35%. Now, if we look at other asset classes, 5-year treasuries during those 8 bear markets, again, stocks fell an average of 35%. 5-year treasuries, intermediate term high quality bonds issued by the U.S. government, were up an average of 11%. Now, you may be thinking, well, interest rates are much lower than they were in the past and might not provide as much of a buffer, and that's true. But I think the idea here is that bonds provide a stabilizer when stock markets fall off. So there wasn't one time when intermediate term treasuries weren't positive when stocks were down during these bear markets.
In a perfect world, bonds will hold up, Stocks will fall, there will be a flight to safety, and bond prices will do well. But there are other things that you can bring into your portfolio. You can bring in gold, which has generally done okay during a recession. You can invest in other strategies, namely trend following or things like momentum. The problem is that people generally don't want these strategies before a recession because they tend to lag a beta-only portfolio. They tend to pile into them after it's already too late.
Huge bear markets, and especially during recessions, which tend to be a little more prolonged in terms of bear markets, that's when you have a strategy like trend following that can have its time to shine. The idea with trend following is that price matters much more than fundamentals over the short or intermediate term, and when prices begin to fall, that attracts more sellers, and when sellers are panicking, they're going to care more about prices and direction of the markets than fundamentals. And so one of the best things you can do with the trend following strategies is that it's rules based.
So I think the best thing that an investor can do to bulletproof themselves for this type of possibility is to have both stocks and bonds, to have what are called negatively correlated assets. This allows investors to rebalance and turn a negative into a positive, especially if you're in the phase of life where you're first accumulating your wealth. You actually have nothing to fear from falling stock prices because you're a forced buyer for the next decade, 2 decades. You actually have to buy. Nothing would be better than having the ability to add to a 401k at lower valuations rather than higher valuations. The other thing to keep in mind is that those types of rebalancing trades and those types of contributions that you're making during a recession, they're the hardest thing to do. Because when you're adding to stocks and stocks have been down 20% already, you feel like you're catching a falling knife. And you can go months and months and months where each successive purchase looks worse and worse. But in reality, the trades that are the hardest to do today are the ones that you'll be the most gratified about when you look back. Your future self will be thrilled that you stuck to your plan. Having an asset allocation plan, having rules in advance, not making things up on the fly, not giving in to what feels good, like swinging to cash or halting contributions, that's going to be the key here. That's how you're going to turn a recession and an accompanying bear market from a negative into a positive.
Why are economic recessions ultimately good for investors? Well, the short answer is they're not. They affect employment, they affect real people losing their job, potentially losing their homes. Recessions are not a good thing. Certainly not on the individual level. Recessions are good for people who are contributing to their 401k every 2 weeks. This makes the obvious assumption that that you don't get laid off in a recession.
So the obvious one here is the fact that you can buy financial assets on the cheap. Stock markets fall because dividends rise, valuations fall, and expected returns tend to rise. So I looked at the end of each recession since World War II. Again, 11 recessions. I looked at the S&P 500 returns going 3 and 5 years into the future. The average return over 3 years was 45%. The average return over 5 years from the end of a recession was 120%. The worst 5-year return was a positive 25% return, and there wasn't a single 3 or 5 year return where stocks weren't positive following a recession.
Well, consider this. A recession typically sends the stock market lower, although again, to varying degrees and for varying periods of time. But you're buying the assets that will comprise a part of your portfolio at a lower price. At a lower valuation, and lower valuations imply higher expected returns. This is a constant throughout history. The lower you're buying, I don't care if it's bonds or stocks or whatever the case may be, the lower you're buying, the higher your prospective returns could be. And of course, it works conversely. No one who's amassing their wealth now should be rooting for all-time highs. It does absolutely nothing for you, especially if it's in a tax-deferred account and you can't even pull the money out anyway. So arguably, recessions can be your best friend if you've got a time horizon to allow for that.
The other thing that happens is typically housing prices go down. So if you're in the market for housing, that can actually be a positive. The double-edged sword here is that if you are in a current house and you have to sell, you're probably selling at a lower price. So this is probably more of a thing that's better for young people who can actually get financing. And one of the positives for the financing angle here is that mortgage rates have actually fallen an average of about 1.8% during a recession. Hopefully, if you're able to get financing and your finances are shored up, you can maybe get a cheaper house with lower financing rates.
I think it's also worth pointing out that some of the most successful companies in history were founded during recessions. And these include everything from IBM to General Electric, Microsoft, Burger King, Disney, CNN, Uber was actually founded during the last recession. And needless to say, as the economy crawls out of recession and these new and innovative companies have come along, people have invested in them, they've done very, very well for themselves. Why do so many great companies get founded during recessions, so many success stories? Well, think about it. They're hiring people at a lower cost per head because people need jobs more than they do in a booming economy. They're able to lease office space at a lower cost. They're able to, in many cases, acquire the unfinished goods and commodities that they need to make their product at lower prices. So not only are recessions good for investors long term, they're a very healthy part of the economic cycle, and they give young, new, innovative companies a chance to compete with incumbents and do some things that they would not ordinarily be able to do when getting started.
I think the biggest thing when thinking about recessions is just try to avoid extremes. So they're a feature, not a bug of our system. There's two opposite camps because some people are always constantly preparing for a recession to their own detriment. Other people just try to pretend like they're never going to happen. And both of these crowds tend to overreact. So the idea here is that you always assume that a recession is going to be part of your future. I'm still a relatively young guy. I know over the course of my investing life cycle, I'm going to run into, potentially a dozen more recessions in my lifetime. That's just a fact. I don't know when they're going to happen, but I think it's important to take them into account when you're planning for your finances and your investment portfolio, and just understand that they're a feature, not a bug, and they're going to happen whether you like it or not, unfortunately.
Once again, this has been FAQ. On behalf of Ben, Michael, and myself, we appreciate you watching. If you're a new investor and you'd like some help with this, we launched Liftoff, an automated asset management program just for you. Go to liftoffinvest.com, check it out for yourself. Thanks for watching, and leave any future show ideas that you have for FAQ in the comments below. We'll talk to you soon.